Robinhood stock just capped off another eventful day on Wednesday, September 17th, finishing up $1.26, or just over 1%, to close at $118.64. It was a day when the Federal Reserve handed down an interest rate cut of 0.25%, with additional signals that as much as 3 more quarter-point cuts could arrive before the end of 2025. The broader market reaction was generally positive, though somewhat measured, with many growth-oriented names finding a little bit of support on the back of that policy decision. For Robinhood specifically, the move higher was modest compared to some of its recent surges, but it still showed resilience. What makes this especially interesting is that the stock dipped earlier in the day, even briefly testing lower levels, before recovering in the afternoon session to end on a positive note. The question investors are asking now is simple: how much of Robinhood's current momentum is being powered by macro factors like Fed policy, and how much is tied to company-specific catalysts like the upcoming S&P 500 inclusion? And more importantly, what should traders and long-term shareholders be watching as we head into the next pre-market session on Monday? The first thing to address is the Federal Reserve's decision itself. Rate cuts are a double-edged sword for Robinhood. On one side, they can weigh on the company's net interest income. That's the revenue Robinhood earns by holding customer cash balances, margin balances, and other interest-sensitive assets. Over the past year, with rates higher, Robinhood has benefited enormously from that stream. Lowering rates put some pressure on that part of the business. But on the other side, lower rates tend to lift investor sentiment. Cheaper borrowing costs, greater liquidity, and a generally more supportive macro environment tend to drive risk appetite higher. For a company like Robinhood, which thrives on transaction volume, that can offset and even outweigh the drag from lower net interest margins. In other words, even if the company earns less interest on idle cash, it may earn more through active trading as more people put their money to work. That's particularly true in crypto, which has historically reacted positively to easier monetary conditions. Now, on Wednesday's session, did the Fed decision directly drive Robinhood's trading? It's hard to say definitively, but the timing certainly suggests it was a factor. The market was subdued before the announcement, and Robinhood wasn't showing much energy. But once the rate cut was confirmed and Jerome Powell's comments made it clear more cuts could come, Hood found support and pushed higher into the close. The modest 1% gain doesn't look dramatic compared to recent 15% days, but in the context of a cautious market, it shows strength. Beyond the Fed, is there any other news directly impacting Robinhood? The answer appears to be no major new headline specific to the company today. The story remains largely about what we already know: the confirmed S&P 500 inclusion later this month, the expected passive inflows from index funds, and the broader narrative of Robinhood maturing from a volatile disruptor into an established financial institution. That said, some analysts are beginning to revisit their price targets and ratings in light of the inclusion, which could be adding quiet support to the stock. It's also worth remembering that Robinhood is still benefiting from buzz around its recent Hood Summit, where the company announced a suite of new products and features designed to appeal to both retail traders and more advanced users. Things like Robinhood Social, AI-powered indicators, and futures contracts represent real attempts to expand beyond the company's original identity as a simple brokerage app. That narrative of product diversification gives institutional investors more confidence in Robinhood's long-term roadmap, even if it isn't directly moving the stock on a day-to-day basis. So if Wednesday's move wasn't flashy, why does it matter? Because it shows Robinhood holding its ground. After a massive rally sparked by S&P inclusion news, it's natural to expect some consolidation, profit-taking, or sideways trading. But instead of pulling back sharply, Hood managed to push slightly higher on a macro catalyst that didn't directly benefit all of its peers in the same way. That suggests underlying strength and persistent demand for the stock. As we head into the Monday pre-market, the key angle here is connecting the dots between macro momentum and company-specific catalysts. The Fed's shift toward easing policy is good for sentiment in general, but Robinhood is uniquely positioned to capitalize because of its business model. Unlike a traditional bank, where rate cuts hurt margins more than they help lending, Robinhood benefits when investors are active, when risk appetite is high, and when crypto is moving. Rate cuts have the potential to reignite all of those dynamics. At the same time, the looming S&P 500 inclusion creates a powerful tailwind. Index funds will need to buy billions worth of Hood shares before the rebalance date. That creates a steady demand floor, one that's less sensitive to short-term profit-taking. Add to that the fact that Robinhood has been delivering strong fundamentals: 42 cents in earnings per share last quarter, $989 million in revenue, up 45% year over year, 26.5 million funded accounts, and average revenue per user rising to $151, and you've got a company that is already showing real traction. Investors should still be cautious. The valuation remains rich, with a forward price-to-earnings ratio above 40. That means expectations are high, and any disappointment could hit the stock hard. Crypto, while a growth driver, remains volatile and could cut both ways. And regulatory uncertainty is always hovering over Fintech, especially as Robinhood explores new territory like tokenized assets. But taken together, the story is strong. Rate cuts help trading activity, S&P inclusion creates inflows and legitimacy, fundamentals show real growth, and the product roadmap is ambitious. The risks are real, but so is the opportunity. For traders looking at Monday pre-market, the levels to watch will be whether Robinhood can build on its current support above 115 and test higher resistance in the 120 range. If the stock consolidates just under that mark, it could set up for another leg higher as passive flows increase. If it slips back closer to 110, it may simply be digesting gains before the next push. Either way, the cautious bullish outlook remains intact. So what's the video angle for Monday? It's this: Robinhood continues to ride the wave of its S&P 500 inclusion, and now it has a macro tailwind in the form of Fed rate cuts. Together, these catalysts position Hood as one of the most interesting growth names to watch in the weeks ahead. The key for investors is to separate short-term noise from long-term signal. The signal is clear: Robinhood is stronger, more legitimate, and better positioned than it has ever been. The noise will be volatility, profit-taking, and daily swings. But in the bigger picture, the trajectory is upward. As we prepare for the Monday pre-market, the cautious bullish case is simple. The Fed has turned supportive, Robinhood has index inflows coming, and its fundamentals are robust. The risks, valuation, crypto, regulation, are still there, but for now, momentum is on its side. That's the story for Robinhood heading into Monday, a company validated by the S&P 500, lifted by Fed policy, and watched by investors around the world. The ride won't be smooth, but the direction looks set.